We're talking about closed-end management companies. Then remember, managed companies manage for a specific investment objective. It might be growth, it might be income, whatever the investment objective is. But the difference is a closed-end usually has one capitalization time. So meaning they have an IPO, an initial public offering. At the initial public offering, the company can either raise equity, common stock or preferred, or even they could sell bonds, rate a limited amount of debt. So it's a one-time offering. Once the offering is closed, then it trades in the secondary market by supply and demand. So it can trade on the exchange or over the counter. It may trade at a premium or a discount to the net asset value. Jim, can you give us an example where a closed-end fund might trade at a premium or a discount to its NAV?
Yes, certainly, Dee. Well, as an example, if we have a closed-end fund that may be trading perhaps lower than NAV due to the fact that the demand for the fund is not as great as it may have previously been. And the reason this is important from a test-taking point of view is that you can have a question that may be seeking to have the candidate identify an answer option that may be identifying and relating or describing how a closed-end fund may be selling below NAV. And if in fact that's the case, then you want to make sure we understand that open-end funds will not be redeemed at less than NAV, but closed-end funds can sell in the secondary market below NAV as well as at or above NAV.
Terrific. So it's important to note when you're taking the exam, if the shares are trading below their net asset value or very far above their net asset value, we'll know and recognize it as a closed-end fund. Lastly, a closed-end fund, the company will not redeem its shares. The shares are traded in the secondary market only.